Welcome back to the week that was. It is Saturday, February 14th, 2026.
Happy Valentine's Day.
Happy Valentine's Day to everyone listening. Whether you're celebrating with flowers and chocolates or, you're just alone in a dark room refreshing your portfolio app, we are glad you're here.
And honestly, if you were refreshing that app today, you might be wondering if your screen is frozen.
Yeah, totally.
The market feels a bit like a roller coaster that's stuck at the top of the hill, just waiting to either drop or launch.
Exactly. Bitcoin is just sitting there right around $68,000.
It's been, well, choppy is a very polite word for it.
Choppy implies movement. This feels more like a standoff. I spent half the week just watching the charts, and I feel like I'm watching paint dry.
Right.
We had that dip, then the squeeze, and now it's just hovering. If I'm just looking at the price, it feels like a really, really boring week. Am I missing something?
You are absolutely missing something. In fact, if you're just watching the ticker price this week, you're missing the entire story.
Yeah.
Well, the price has been boring. The structural tectonic plates beneath the market have shifted more in the last 5 days than they have in the last 5 months.
Okay, that sounds dramatic. Tectonic plates.
It's not an exaggeration. We are seeing what I'm starting to call the Great Divergence.
The Great Divergence.
Yeah. On one side, you have retail investors, regular folks, and they're fleeing because the macro headlines are scary, they see the price stalling, and they get out.
Okay.
But on the other side, the institutional side, you have corporations, banks, and even governments quietly and massively deepening their infrastructure.
So the price is screaming fear, but the plumbing is whispering greed.
That is the perfect way to put it, and we have a lot to cover to prove that thesis.
Right.
We need to talk about the corporate sector basically splitting in two. Why one company sold over $300 million in Bitcoin to buy computer chips, while another just doubled down.
And we definitely need to talk about South Korea. I saw this headline about a ghost coin scandal, something about billions of dollars. Sounds like a movie plot.
It was a $43 billion error, to be exact. And it's rewriting the entire regulatory rulebook in Asia as we speak.
Wow.
We'll also look at why Goldman Sachs seems to be rotating out of Bitcoin and into utility coins like XRP and Solana.
Okay.
And finally, we have to unpack the macro trap that caused everyone to panic earlier in the week.
All right, grab your coffee or your Valentine's champagne. Let's get into it.
Let's start with the corporate sector. For the last few years, we've had this sort of monolithic idea of a Bitcoin company.
Right, a high beta play. Bitcoin goes up 5%, the stock goes up 10%.
Exactly. If Bitcoin drops, the stock crashes.
Yeah.
But this week, that whole identity completely fractured.
How so?
Companies are picking lanes, and they are very, very different lanes. The biggest headline was Kango Inc.
Kango, yeah.
They made a massive move that caught everyone off guard. They sold 4,451 Bitcoin.
That's a huge amount of selling pressure. That generated what, over $300 million?
$305 million in cash. Now, usually when a company sells that much Bitcoin, you assume they're bearish.
Right, they think the price is going down.
But Kango didn't sell because they hate crypto. They sold it to pivot entirely to AI inference.
So they are swapping digital gold for computer chips.
It's the compute beta. Think about it this way. The stock market right now is just obsessed with artificial intelligence.
Completely.
They're willing to pay a massive premium, a really high multiple, for any company that owns GPUs, the chips that run AI. But they're paying a much lower multiple for companies that just mine Bitcoin.
So Kango looked at their balance sheet and said, we're holding the wrong asset for this market.
Precisely. They engaged in an arbitrage of business models. They realized if we sell this Bitcoin, which the market's kind of bored with, and buy GPUs, which the market loves, our stock price will go up.
They're stripping the assets to become a tech infrastructure company.
It makes sense. You chase the valuation, but then you look at the other side of the ring, and you have the heavyweight champion of holding Bitcoin, MicroStrategy.
I assume they aren't pivoting to AI.
No. If anything, they are digging the trench deeper. In direct opposition to Kango, MicroStrategy issued more equity to buy an additional 11,142 Bitcoin.
For $90 million.
Right. But here's the part that really matters. It's how they are funding it.
I saw this. They increased the yield on their stretch preferred stock to 11.25%. That number jumped out at me.
It should.
I mean, 11% is basically a junk bond yield. Why are they paying that much interest?
Because they are targeting a very, very specific type of investor. They aren't looking for the crypto bro who wants to, go to the moon.
Who are they looking for?
They're looking for the conservative pension fund manager who needs fixed income.
Ah, I see. So the pension fund sees 11% return and just thinks that's safe, consistent money.
Exactly. MicroStrategy is taking that conservative, boring capital and pouring it directly into the most volatile asset on Earth. It's incredible financial engineering.
They're bridging the gap between old world fixed income and new world digital assets.
So you have Kango saying, we want to build the AI internet, and MicroStrategy saying, no, we want to own the money of the internet.
And the market is starting to forcefully separate those two things.
Yes, and we saw a fascinating report from Morgan Stanley this week about the miners that proves it. They are completely changing how they value these companies.
How so?
For years, if you analyzed a miner, you looked at hash rate. How much computing power do they have?
Right.
Morgan Stanley basically said, we don't care about that anymore. They now care about power capacity.
So they just want to know how many megawatts you have plugged into the wall.
Yes. They rated firms like Cypher and TeraWulf as buys. Why? Not because they mine Bitcoin efficiently, but because they have these massive power connections that they can lease to big tech for AI.
So they're becoming landlords for the AI revolution.
Exactly. And the pure miners, the ones just holding Bitcoin.
Let me guess, underweight.
Underweight. Discounted. The market is sending a clear signal. Either build the infrastructure for the digital age or get out of the way. If you're just holding the asset, the market isn't as interested right now.
Speaking of infrastructure and failures of infrastructure, we have to talk about South Korea.
Oh, absolutely.
You mentioned the ghost coin scandal. Walk me through this. How do you accidentally create $43 billion?
Oh, it sounds impossible, right? This happened on February 6th at Bithumb, one of the biggest exchanges in Asia.
And it wasn't a hack.
No, it wasn't a blockchain hack. It wasn't someone stealing keys. It was a reconciliation failure.
Reconciliation failure. That sounds like some very polite accounting jargon for oops.
It's a massive oops. Basically, an internal ledger mistake a glitch in their database credited users with 620,000 Bitcoin.
Wait, 620,000 Bitcoin? That's huge. That's a massive percentage of the total supply.
It was 14 times larger than the exchange's actual reserves. Imagine logging into your bank app and seeing $40 billion just sitting there.
I'd probably faint or try to withdraw it immediately.
And that's exactly what people did. Users started trading it. They were selling this ghost Bitcoin for real Korean won.
But the Bitcoin didn't actually exist on the blockchain, right?
No. And that is the terrifying part.
Yeah.
It exposes that these exchanges are essentially operating like black boxes.
You think you own Bitcoin, but really you just own a row in their database.
Precisely. This was a Sputnik moment for Seoul. The regulators realized we have no idea what is going on inside these companies.
So I assume the hammer's coming down?
The hammer, the sickle, the whole toolbox. The Financial Supervisory Service, the FSS, launched a full-scale investigation.
And the result?
More importantly, South Korea is moving to what they're calling a public utility model.
What does that mean for a crypto company?
It means they are effectively nationalizing the oversight. They are lifting the ban on corporate crypto trading, which sounds good.
But there's a catch.
A huge catch. They are installing AI surveillance systems and strict bankled controls.
Yeah.
The government is saying, if you want to handle money, you will be regulated harder than a bank.
So the era of the scrappy startup exchange is just over in Korea.
Completely. The Wild West days of the kimchi premium are done. And look at Mirai Asset Group. They are a massive, stuffy, traditional finance firm. They just bought 92% of Corbett, another exchange. The banks are buying up the infrastructure because the startups proved they couldn't handle the plumbing.
It's interesting you mentioned banks taking over. We saw a similar thread with Russia this week, right?
Yeah.
Sberbank.
Yes, Sberbank is Russia's largest bank. They launched crypto-backed loans for corporations.
But this isn't for speculation.
No, this is explicitly to help companies evade sanctions.
So in Korea, crypto is becoming a regulated public utility. In Russia, it's becoming a geopolitical tool for banking.
The asset is maturing, but it looks very different depending on where you stand on the map. It's becoming part of the furniture of the global financial system.
Which brings us back home to Wall Street. We got the 13F filings this week. For listeners who don't speak finance, what is a 13F?
A 13F is a report that big investment managers, anyone managing over $100 million, have to file with the SEC.
It's like a peek into their poker hand.
Exactly. It reveals what they bought and sold in the last quarter. It's how we see what the whales are doing.
And Goldman Sachs showed us their hand, and it was unexpected.
It definitely raised some eyebrows. Goldman cut its Bitcoin ETF exposure by nearly 40%. They sold about $1 billion worth.
Okay, so they're out. They're bearish.
That's what the headline would say.
Yeah.
But if you look closer, they didn't leave the sector at all.
What did they do?
They bought over $150 million in XRP and Solana ETFs.
Why swap Bitcoin the king for XRP and Solana?
It goes right back to that utility theme we talked about with Kango. Goldman is betting on transactional utility.
Okay.
They see XRP as a potential settlement layer for cross-border payments. They see Solana as high-speed infrastructure for things like tokenized assets.
So they're rotating out of the store value trade.
And into the plumbing trade, they're trying to pick the winners of the infrastructure build-out rather than just holding digital gold.
And they aren't the only ones doing this kind of thing. We saw a huge integration involving BlackRock this week.
Right. BlackRock, Securitize, and Uniswap.
I know Uniswap. That's a decentralized exchange. It's usually where people trade meme coins. What is BlackRock doing there?
This is a collision of worlds. BlackRock has a fund called BUIDL, which is basically tokenized U.S. Treasury bills.
So government debt on the blockchain.
Yes. And as of this week, that fund can now be traded directly on Uniswap.
Wait, so I can swap my USDC for U.S. Treasury debt on a decentralized exchange?
In theory, yes, if you're a qualified investor.
Yeah.
But the bigger picture here is that BlackRock is validating public blockchains, specifically Ethereum in this case, as a settlement layer for sovereign debt.
It creates a compliant bridge where institutions can use decentralized rails but still follow the rules.
That's it. But it's funny. While Goldman and BlackRock are making these sophisticated long-term infrastructure moves,
The retail investor, the average guy, seems to be panicking.
exactly. We saw huge outflows from the ETFs later in the week. What was it, $410 million pulled out?
Yeah, that's the divergence.
Yeah.
Retail investors saw the price drop, they saw the scary macro headlines, and they sold.
But if you look at the smart money data, firms like Millennium Management disclosed a $1.94 billion position.
And pension funds too, right? CalPERS.
CalPERS, the California Public Employees, they bought more.
So retail is trading the headlines, and the institutions are trading the cycle.
That is usually how wealth transfers happen. Retail provides the liquidity for institutions to enter at a discount.
Speaking of headlines, let's go to Washington. The policy landscape is shifting fast. We had this big standoff at the White House over stablecoins.
The battle for yield. This is becoming the central issue. You have the banks, represented by the American Bankers Association.
And what's their argument?
They're basically saying, if you let stablecoins pay 5% interest, no one will keep their money in a regular bank account.
Which is a valid fear for them. Why would I keep my money in a checking account earning 0.01% if I can get 5% on the stablecoin?
Exactly. They call it deposit flight. And the crypto industry is saying, yield is the innovation. If we can't offer yield, we just lose to foreign competitors.
And there was a proposed compromise, right? The Besant Doctrine.
Right, named after Treasury Secretary Scott Bessent. The idea was to allow yield for accredited investors, the rich folks, but ban it for retail.
Of course. The rich get the 5%, the regular people get 0%.
It's a classic Washington compromise that pleases absolutely no one, and it led to a total deadlock.
But while that stalled, we got breaking news about seized assets. This is actually huge for the supply side.
It really is. This is about the Bitcoin the government seizes from criminals, like from the Silk Road bust.
Right. Historically, the U.S. government has been one of the worst traders in history.
Terrible. They seize Bitcoin and then just dump it on the market at auction, usually crashing the price and losing billions in potential gains.
But that's changing.
Patrick Witt, the executive director for digital assets, confirmed this week they are halting the sales of seized Bitcoin. They're actually auditing the government's wallets now.
I've heard rumors of a strategic reserve. Is that what this is?
They are exploring a budget-neutral way to hold these assets. Basically, they're finally realizing that dumping 200,000 Bitcoin onto the market is just bad policy.
So if the U.S. government stops being a forced seller, that removes a massive dark cloud that's hung over the market for a year.
For years. One more thing from Washington before we move on. The Super Bowl.
Right. The halftime show apparently triggered the SEC.
Yeah, the Super Bowl hangover. Prediction markets like Kalshi hit $1 billion in volume.
People were betting on everything.
Everything. Including what song would be played at halftime? Well, the SEC looked at that and said, that looks like a security. So now we have Project Crypto, a joint effort by the SEC and CFTC to figure out what is a game, what is a commodity, and what is a security.
Never a dull moment. Okay, let's get to the reason everyone was freaking out earlier in the week. The macro situation.
Right.
The data came out, and it was confusing.
Confusing is the polite word. It was a trap. The headline screamed 130,000 new jobs, which sounds great.
But the devil was in the fine print.
The revisions, they revised the 2025 data down by 403,000 jobs.
Wait, back up. How do you just lose 400,000 jobs? Did people get fired retroactively?
No, they never existed. The government basically admitted their calculator was broken last year. They overcounted.
So the economy we thought was booming was actually much cooler.
And that scares the market because it means that the consumer might run out of money faster than we expected.
And then you add in the inflation data on top of that.
Right, CPI. It came in sticky at 0.2% month over month. So we have a weaker job market than we thought, but inflation isn't going away.
That sounds like the worst of both worlds.
It killed the hopes for a March rate cut. The market immediately repriced risk. If rates stay higher for longer, money is expensive.
And that hurts assets like Bitcoin.
Absolutely. And that explains the sharp drop we saw. But then we saw it bounce.
Why? What was that?
That was pure market mechanics. The price dipped on the bad news. Retail traders panicked and shorted the bottom. They bet it would go down to 60K.
Uh-oh.
Then large capital stepped in, swept the entire order book, and liquidated $144 million in shorts.
A classic squeeze. The pros taking the lunch money from the amateurs.
Ruthless, but efficient. And amidst all this, we have these conflicting forecasts. Standard Chartered cut their target to 100K, blaming those high rates.
But Bernstein is saying something different.
Right. Bernstein calls this the weakest bear case in history.
Why weakest?
Because there are no dead bodies. In 2022, we had FTX collapsing, Luna blowing up. Now, companies are solvent, miners are efficient. It's just macro anxiety.
So Bernstein thinks once the liquidity eases up, the rally just resumes.
That's their thesis.
So let's try to synthesize all of this. We started by calling this the Great Divergence. What does that actually mean for the person listening right now?
It means we are in a phase where the price signal is temporarily broken.
Okay.
The price is being suppressed by these macro fears, interest rates, inflation, job reports. But the plumbing of the financial system is aggressively integrating this entire asset class.
You look at BlackRock putting treasuries on chain. You look at South Korea regulating exchanges like utilities.
You look at the U.S. government deciding to hold, not sell. Even Russia integrating it into its banking system.
The infrastructure is being built to handle trillions of dollars, even while the price struggles to hold 68,000.
It's like they are building a 6-lane highway while there are only a few cars on the road.
That's the perfect analogy. And the divergence is that retail is looking at the empty road and saying, dead end.
While the institutions are looking at the asphalt being laid and saying, future transport layer?
Which leaves us with a question for you to mull over this weekend. If the price is down and everyone is scared, but the entities that actually run the global financial system, BlackRock, Goldman, the U.S. Treasury, are buying the infrastructure and halting their sales.
What does that tell you about the time frame they're playing on versus the time frame you were watching?
Are you trading the 15-minute chart, or are you investing in the 15-year cycle?
Something to think about.
That's it for the week that was. Thanks for listening.
See you next week.